Let's run through the chapter 25 to 27 and Appendix G review. So our first question here says that Bosch Company purchased at a cost of $30,000. They purchased and used 6,000 pounds of materials during March. Their standard cost of materials per unit produced is based on 4 pounds per unit at a cost of $6 per pound. Production in March was 1,400 units. Using all of that information, we are going to compute the total price and quantity variances for our materials. Now, before we even dive into calculating all of these variances, let's first find these 4 different variables: our actual quantity, actual price, standard quantity, and standard price. So actual quantity, AQ, actual quantity is going to be how many pounds of materials we actually used. So that's our 6,000, because we actually used 6,000 pounds. Actual price, we're going to want a price per pound. So we know that we used 6,000 pounds and it cost a total of $30,000. So if we divide those two, we can see that our price per pound is $5. Now standard quantity is the tricky one here. Standard quantity, we need to take a look at 2 different pieces of information. We're told that our standard is 4 pounds per unit. So going into the month, we expect each unit to require 4 pounds of materials. Then we take a look at our actual production, and we made 1,400 units. So standard quantity is saying, based off of those 1,400 units that you made, how much in materials do you expect to use? So we'll take those 1,400 units, multiply it by our 4 pounds per unit to see that we expected to use 5,600 pounds in this month. Our standard price is a little bit simpler. It's just that $6 per pound that we're told. So now that we have all of those, we can then use those to find our price variance, our quantity variance, and our total variance. So we have these 3 separate boxes set up, right? We have actual quantity times actual price, actual quantity times standard price, and standard quantity times standard price. So we're going to need to find the amounts for all of those. But before we do that, let's take a look at what these pieces make up. So actual quantity times actual price, that first box on the far left. That amount subtracted by whatever actual quantity times standard price will be, will give us our price variance. You'll notice that the variable that changes there is the price. So that's what helps us find our price variance. These last 2, actual quantity times standard price and standard quantity times standard price, the variable that changes there is quantity, and so that finds our quantity variance. And then once you have your price variance and your quantity variance, those 2 amounts can help us find our total variance. So now let's start plugging in numbers. So actual quantity times actual price is 6,000 times 5, then 6,000 times 6, and 5,600 times 6. We multiply all those together, and we get our 3 amounts: 30,000, 36,000, and 33,600. These first 2 help us find our price variance. So we're going to want to subtract those 2 values. We're going to want to take 30,000 minus 36,000. And we get this difference of 6,000, right? That's not the full answer for our price variance. We will also want to know, is this favorable or is this unfavorable? And this is where we need to take a look at our variables themselves. Our actual price is $5 per pound. Our standard price is $6 per pound. So we went into the month expecting to spend $6 per pound of materials. We actually only spent 5. So this will be favorable because we spent less than what we expected to have to spend. So our price variance is 6,000 favorable. Then we can find our quantity variance. So once again, we just want to subtract our two amounts, 36,000 minus 33,600. And we get this difference of 2,400. Once again, we need to find whether this is favorable or unfavorable. So we're going to compare our quantity amounts. We see in the upper left that our actual quantity is 6,000 pounds. Our standard quantity is 5,600 pounds. So we expected to have to use 5,600 pounds of materials. We actually had to use 6,000. Since we actually had to use more than what we expected, that makes this unfavorable. Now, once we have our price and our quantity variance, we can use those to help us find our total variance. So we see that our price variance is 6,000 favorable, and our quantity variance is 2,400 unfavorable. We're going to look at the favorable and unfavorable almost like a positive-negative situation. So since they are different signs, we're going to subtract them. We're going to take the 6,000 favorable, subtract out the 2,400 unfavorable. And we get 3,600 here. Now the 3,600 has to be either favorable or unfavorable once again. Since we have more on the favorable side, we have the 6,000, than we do on the unfavorable side, the 2,400, this total variance is 3,600 favorable. Now, when we were trying to find our total variance here, if both our price and our quantity variance were favorable, or if both were unfavorable, we would then have just added them together. So we would have had 8,400 as our total variance. But whenever they're different signs, like we have in this example, we subtract those two values when finding our total variance. Now, question number 2 gives us a lot of information here. It says Parsons Company manufactures and sells homemade wine, and they want to develop a standard cost per gallon. The following information is the recipe required for the production of a 50-gallon batch. So we have 6 different ingredients. We have grape concentrate, sugar, lemons, yeast tablets, nutrient tablets, and water. And we're told how much of each ingredient will be needed for 50 gallons. So 3,000 ounces of grape concentrate, 54 pounds of sugar. And then we're told the standard price for each of those, the 6 cents per ounce for the grape concentrate, or the 30 cents per pound for the sugar. So we're told all of that information. And remember, that's for a 50-gallon batch. If we want to find the standard cost for 1 gallon, we're going to need to take those amounts and break them down into just 1 gallon amounts. So we're also given some other information down below. We're told that Parsons estimates that 4% of the grape concentrate will be wasted, 10% of the sugar is lost, and 25% of the lemons cannot be used, so they'll be wasted as well. We need to compute the standard cost of the ingredients for 1 gallon of wine. So let's set up a nice table here. So we have our 6 different ingredients down the left side. Our amount of each ingredient in 50 gallons, right? Grape concentrate was the 3,000 ounces. Sugar was the 54 pounds. But we're not looking for the standard cost of a 50-gallon batch. We're looking for the standard cost of a 1-gallon batch. So we want to divide each of these by 50. If we need 3,000 ounces of grape concentrate in 50 gallons, we need 60 ounces in just 1 gallon. So we divide each of our ingredients by 50 to figure out how much we need in 1 gallon of this recipe. Then we have some standard waste. Standard waste was what was given down below. That was the 4% for the grape concentrate, the 10% for the sugar, the 25% for the lemons. Then you'll notice the yeast tablets, nutrient tablets, and the water, there was no waste. So those just have all zeros. Then we get to standard usage. Standard usage is going to be a piece that we have to calculate. So let's first just look at this grape concentrate information. We need 60 ounces of grape concentrate per gallon, but there's going to be 4% waste. So we need to figure out how much of this grape concentrate we actually need to put into this recipe to make this gallon of wine. So grape concentrate with 4% waste, we're going to solve it like this. We have this 0.96x equals 60. So 0.96 we get from 100% minus this 4% waste. X is our standard usage that we're solving for. 60 is the amount of grape concentrate that we need in each gallon. So we will take 0.96x equals 60, divide each side by 0.96 to see that the standard usage for our grape concentrate needs to be 62.5 ounces. So we'll toss that in there for standard usage. Now we're going to do the same kind of thing here for sugar and lemons also. So sugar has 10% waste, lemons have 25% waste. So first, working with the sugar, 0.9x, right, 100% minus 10% gets us this 90%, equals 1.08 pounds of sugar. Divide each side by 0.9, and we see that our standard usage for the sugar is 1.2 pounds. Now lemons have 25% waste. So 100% minus 25% gives us this 0.75. So 0.75x equals 1.2 lemons. Divide each side by 0.75, and we see that the standard usage of lemons in 1 gallon is 1.6 lemons. So then we toss those into our chart here. Now our yeast tablets, nutrient tablets, and water, that had no waste. So the standard usage is the same as just the amount per gallon column shows. Then we come over to the column for our standard price. This is something that was given to us at the beginning of the problem. We were told how much 1 ounce of grape concentrate is, or how much 1 pound of sugar is. So we fill in all of those amounts. So for example, 1 ounce of grape concentrate is 6 cents. Then we get to the standard cost per gallon. So we are going to figure out piece by piece, ingredient by ingredient, how much the cost is for 1 gallon of this recipe. So for grape concentrate, we'll take the 62.5 ounces times the 6 cents per ounce and see that the standard cost per gallon for the grape concentrate is $3.75. Then we continue down. We take the standard usage times the standard price for the other 5 ingredients, and we get all of their standard cost per gallon amounts. The question wasn't asking, though, for the standard cost per gallon for each ingredient. It was asking as a whole. For 1 gallon of this wine recipe, what is the standard cost? So to find the standard cost for 1 gallon, we will add up that entire standard cost per gallon column. So $3.75 plus 36 cents plus 96 cents all the way down. And we see that the standard cost for 1 gallon of wine is $5.78. Now, question number 3. The budgeted selling expenses and actual expenses incurred in December 2019 by Myers Company are as follows. So on the left, we have our budgeted cost. On the right, we have the actual cost. We need to prepare a flexible budget performance report for December, assuming that December sales were $170,000. So what we're going to do here is we're going to fill out this flexible budget performance report. So you'll notice on the left side, it has our budget, and then we have the actual, and then over on the far right is the difference. So this is where we will figure out whether things are favorable or unfavorable. So we fill out all of our budgeted information. Again, our budget data and our actual data were given to us on that last slide. Then we come over to the actual. And we were told that our actual sales commissions were $11,000. And again, that came from the chart on the last slide that we had. So if we budgeted for our sales commissions to be $10,200, but they were actually $11,000, that's a difference of $800, and it's unfavorable because our actual cost was more than our budgeted cost, right? We want our costs to be low. So favorable would mean that our actual cost was less than our budgeted cost. But if our actual exceeds our budgeted amount, that's when we run into this unfavorable difference. Now for advertising, our budgeted amount for advertising was $6,800. Our actual was $6,900. Once again, our actual is higher than our budget, so it's going to be unfavorable by that difference of $100. Traveling, our budgeted amount was $5,100. Our actual amount was $5,100. So there is no difference. Then delivery, we budgeted for $3,400, and our actual was $3,450. So again, our actual is higher than our budgeted amount, so it's unfavorable for that difference. Our total variable cost, we're just going to add up our 4 different variable costs here, and we get $26,450. Now, for the difference column here under total variable costs, 2 different ways that we can figure this out. First way, the same thing that we've been doing, comparing the actual to the budget. We see that our actual variable costs are higher than our budgeted amount, so it's going to be unfavorable. We'll take the difference between our 2 variable costs amount, and that will give us our number. Another way that we can do it is by looking at the difference column that we already have. Just like when we were dealing with our materials variance before, we treat favorable and unfavorable almost like positives and negatives. So if they're all the same sign, like they are here, they're all unfavorable, we can add up those 3 values, 800, 100, and 50. Those all add up to our 950 unfavorable amount. But again, we could also find that 950 by just taking the difference between our budgeted total variable costs of the $25,500 and our actual total variable costs of the $26,450. Then we get down into our fixed costs. Our fixed costs all remained the same. So we don't have any differences there for our fixed cost. Now our total cost. For the total cost, we take our total variable plus our total fixed. So $26,450 plus $43,000 gives us a total cost amount of $69,450. For the difference column here, once again, there's two different ways that we can go about this. We can just compare our two total cost amounts. $68,500, $69,450. If you subtract those, you'll see a difference of $950. Another way that we can do it is by taking a look at our total variable and our total fixed over in the difference column. Total variable costs were $950 unfavorable for the difference. Total fixed cost didn't have a difference. So if you add those up, the $950 plus the 0, we still stick with that $950 difference on the unfavorable side. Now we're going to talk about net present value. So we're going to be given two different projects here. We need to figure out the net present value for each project and decide which project should be accepted. So this problem says Sullivan Company is considering two different capital expenditure proposals. Project A will cost $450,000, has an expected useful life of 11 years, a salvage value of 0, and is expected to increase net annual cash flows by $73,500. Project B is going to cost $300,000, has an expected useful life of 11 years, a salvage value of 0, and is expected to increase net annual cash flows by $50,000. A discount rate of 9% is appropriate for both projects. So project A is a little bit more expensive, but also will increase our net annual cash flows by more. So we're trying to figure out, should we spend that extra $150,000 for the little bump in net annual cash flows? The way that we're going to figure this out is by finding the net present value for each project. So we have this chart here. This chart's going to tell us some interest factors. And we can use these interest factors to help us find the present value of an annuity. And since these are annual cash flows, that's what makes it an annuity. We're going to be receiving these $73,500 here for project A every single year. So the way that we read this chart, down along the left side is the number of payments. So this is where the 11 years comes into play. So we have the 11. Up along the top is our percentages. So we have a discount rate here of 9%. So we see where the 11 and the 9% intersect, and that gives us this interest factor of 6.805. So we'll use that to help us find the present value of these net annual cash flows. So we take that $73,500, those were our net annual cash flows for project A, multiply it by our interest factor, and that tells us that the present value of those net annual cash flows is $500,181.47. So that's step one when finding the net present value. Then we subtract out the capital investment, the cost of this project. That was $450,000. That will tell us that the net present value is the difference of those two, which is a little bit more than $50,000 here. So we'll keep that in mind as we now shift over into project B. Project B has the same expected useful life and the same discount rate. So we're going to end up with the same interest factor here of the 6.8. But what changes is our net annual cash flows are now 50,000 and our cost is 300,000. So we do get a different answer here. So we take that 50,000, multiply it by our interest factor, and we see that the present value of all of those annual cash flows is $340,259.50. Now we subtract out the capital investment, the cost of this project, that 300,000, telling us that the net present value of project B is right around $40,000. So now we need to figure out which project is going to be accepted here. Both projects have a positive net present value. That's good. That means that both are somewhat acceptable. But there's definitely one that's better than the other. So we want our net present value to be as big as possible. So we're going to go with project A. So even though project A cost more up front, there was that capital investment of $450,000. It has a better net present value. So that's the project that we should accept. Now we get to the cash payback period. Cash payback period is how quickly are we going to get our initial investment back in just pure cash dollars, right? So we aren't really worried about present value or anything like that here. We just want pure dollar and cents. When are we going to get this money back? So Owen Company is considering two new projects here again, Project A and Project B. Both projects will last for 5 years and will require an investment of $35,000. The projects, though, will produce different net annual cash flows. So you'll see Project A. Project A's cash flows are all over the place. $8,000 in year 1, $12,000 in year 2, a little bit of a dip in year 3, and then a big jump there in year 4. We're making $25,000 that year. That's great. So in total, Project A is going to give you $75,000 in cash flows. Project B has consistent annual cash flows, $14,000 every year. A bit of a downside right now as we look at this, we see that the total is only $70,000. So we'll keep that in mind as we go through this calculation. Owen Company will not accept any project with a cash payback period over 3 years. So if it's more than 3 years, they're not even interested. So we need to compute the cash payback period for both projects and determine which project is more desirable. So let's start with Project A. And when we have different cash flows every year, we should set up a table like this, where we have our different years, we have our net annual cash flows, and then we keep track of our cumulative cash flows. So as we're going, how much have we made? Right? So for year 1, we made $8,000. So our cumulative cash flows is $8,000. What we want to figure out is when does that cumulative cash flow amount exceed our initial cost of that $35,000. So in year 2, we made another $12,000. So $12,000 plus the $8,000 that we've already made gives us this $20,000 here for our cumulative cash flows. Year 3, we made $7,000. So that brings our cumulative cash flows up to $27,000. We're still not past that initial investment though. Year 4, we make $25,000. So we add that to the 27, and you can see that we've finally now passed the initial investment of $35,000. So at some point in year 4, we make back all of this money. We need to figure out at what point in year 4. So the way that we're going to do that is we need to figure out, going into this year, going into year 4, how close were we? So we take the $35,000 of the initial cost and subtract out the cumulative cash flows from year 3. So going into year 4, we needed to make another $8,000. So we're going to assume that these $25,000 that we make in year 4 are spread out evenly throughout the year. So we can take the $8,000, divide it by the $25,000 that we make in year 4, and that's going to tell us that 0.32 of the way through year 4, we made this $8,000. So roughly a third of the way through the 4th year, we make back our money, which means our cash payback period is 3.32 years, because we needed all 3 of the first years plus 0.32 of that 4th year. So remember, Owen Company's not interested in a project with a cash payback period of over 3 years. Well, this one's over 3 years, so Owen Company isn't even going to really be interested in this project. So let's figure out if Project B is better. Project B has even cash flows. So we could still go through and make a table like we did here for Project B. But when we have even cash flows like this, when we have the same amount every single year, we can just use this formula of our cost of our capital investment divided by your net annual cash flows. It's going to make it way easier to find your payback period. So $35,000 for our initial investment divided by our net annual cash flows of this $14,000. And we see that our cash payback period is 2.5 years. So that is better than what we had for Project A. Project A had 3.32 years. Project B had 2.5 years. So, a few reasons why we should choose Project B. Has a lower cash payback period. That's first and foremost. But we could also eliminate Project A, like we said, just because Owen Company doesn't want a project where the cash payback period is over 3 years. Well, Project A gets eliminated then. And in that case, Project B, it at least fits that role. So we're going to go with Project B. Now, one last thing to think about here. Project B gives you less of cash flows. Project B's total is $70,000. Project A's total is $75,000. So just because Project A has a higher total does not mean that the payback period is going to be better. It just means that you're going to get more money, but as we can see here, it can also be backloaded, meaning in the final couple years, we see that huge jump.